So as you're thinking through all this, I want you to just really envision where your startup is, right? Or your company. And what are some of the things that you need to think through to make sure that you are aligning yourself and you're aligning your resources and the things and the questions that you need to ask yourself, what do I need to do to be a successful business? So let's talk about what we call in the startup world, we call it the valley of death, right? Every startup kind of goes through this place, trying to figure out kind of profit and loss, where they are. They started with the idea and how do they get to a place of just commercializing, breaking even, or even just being successful altogether, right? To be able to navigate this process, right? It takes money to do that. And to be able to navigate to sustain the business to be successful, either that of a customer or either that of some debt, some equity, or some additional financing or some friends, right? Every business, I don't care what the technology is, needs to understand kind of where they are, what they need to do in order to get themselves to a place of actually being successful. So when we think in terms of the technology versus the business funding, it's one thing to understand your technology, but you need to make sure that you understand your markets and then how to protect all of your technology and what partnerships and agreements that you need to have and need to be in place in order for you to be a successful business so that you can make sure that you're a success and having the proper business formation related around your business, right? So when we think through some of the funding milestones, and now we're getting into the meat of what this lecture is about. So when you think of the ideal and the feasibility and what do you actually have to de-risk from the funding stage all the way to expansion and growth, you have to think through the valleys and what you need to break to. So it breaks it. So I break it down into these fundamental buckets right here: funding and seed funding, R&D capital, go-to-market capital, and expansion capital. All these are part of what I like to call your fundraising strategy. I don't care what business you're in, everyone passes through this tranche, so to speak, right? So I want to help walk us through what that actually looks like. So when we think of terms of the financing cycle, everybody starts at very early on, whether they're validating their individual tech, right? When I say fundraising is a strategy, whether it's debt, equity, capital, all of that, it's a strategy, right? So when we think in terms of the cash that we need very early on, this is what we call the tech validation stage, right? You've clarified a mission. And in this stage, it may be a little bit of federal, state, and R&D money, and maybe family, friends, and then now the fools is in there. That might be some of the dollars that are kind of added in this particular stage from the tech validation component. And then as you continue to grow, as you begin to characterize your business and you got a little bit of traction, you've got some customers, now you're moving into the market validation stage. Then at that point, then maybe you start to take on a little bit of angel dollars and a little bit of seed funding, or maybe a little bit of debt equity at that point, because now you've validated your product, your technology, and it works, your customers or your process or your procedures or your item or your manufactured product. And now you're able to move from the validation state to a market validation point, because now you're heading in the direction of actual growth. And these are actual phases that I see with startups that navigate this and understand the fundraising process end up usually being successful. Particularly when you get to the channel validation, this is that stage that now you're taking on venture capital dollar, corporate ventures, M&A, private equity, and some debt, right? Now you're at the stage where you're either about to exit, you're about to IPO, or someone's about to buy you, or now you've got customers, you've got revenue, and you're just needing an investment for growth and for further expansion. Again, understanding your financing cycle, understanding the strategy that you need to have for your business. And again, I don't care what your business is, every business needs to have a strategy in terms of their dollars, their funding, how they make money as they navigate through this. And then when you think of the later stage, that's when you get into the product margins, private equity, M&A, debt, or IPO, where your business is being acquired or your business is taken on. So you got to understand the dollars you need versus cash versus the risk versus the revenue basis in terms of where you are. When we look in terms of just from our perspective, and just jumps into a little bit of technical stuff, but I'm going to talk about this in context of SBIR dollars and non-dilutive dollars. And let's just use the example of a terminology that we use specifically with the Department of Energy and DoD. We use a technology called investment readiness levels, or TRL levels, which gives an assessment of kind of where your technology is. Now, everybody is very different in that regard in terms of your technology, but we have to understand in terms of where are we, when are we ready to actually launch, what dollars do we need in that regard. So I'll speak through this example, but in this context, for those that it's applicable to, if you have a technology that you're trying to pursue non-dilutive dollars like SBIR, Usually, typically after that, you're kind of looking at a TRL level when you're getting at a 5 or 6, when your business is somewhat successful in that regard and ready to go. So just again, just understanding funding cycles, understanding where your business is and what dollars that you need to take, and maybe a little strategic dollars that come alongside that. So let's kind of unpack the financing a new business. Kind of where do we find the money, so to speak, right? Or what is it going to cost, or what is the right match for us? When we think in terms of the different types of financing, again, there's non-dilutive dollars. That means grants, money for a cause, right? That's money that's out there. I don't want to call it free money, but it's money that taxpayers pays, but it's given to you to help expand. And it doesn't necessarily always have to be a technical business for you to receive grant funding. There are plenty of organizations out there that provide grant funding and small microloans on money to organizations and businesses to grow, to scale. And it doesn't always have to be something tech, AI, or machine related, or learning related. It doesn't have to be technical. There is plenty of grants and funding out there. You just have to do a little homework to kind of find what those things are. Yes, yes.
However, Dr.
Yeah.
How easy is it to get that?
It's very difficult to get grant funding. Yeah. It's very difficult. Yeah, I don't want to make it seem like, oh, you just signed and they're going to give you the check. That would be too much like right, wouldn't it? But no, it is very difficult to get these dollars. But having in place all the things that I'm talking about helps increase your odds. And that's why I wanted to set context before we start talking about the models of funding, because it's a moot point to talk about those things. It's like giving someone $1 million that's never had financial planning or never budgeted anything, right? They will lose all that money in the next 60 days, right? So that's the purpose and point of that. So the cost is operational hurdles, time for success. It's help expectations, successful completion of a project, societal impact. Non-dilutive dollars can tremendously help startups or companies grow really, really fast, because these are dollars you typically don't have to pay back. But these are dollars that could be helpful for you as a business owner very early on to help build out your solutions. Or equity, selling a part of your company or a percentage of your company, and exit as a profit, right? In terms of that, we talked a little bit about angel and VC dollars. Those are some of the things that we attribute to that. And then debt, borrowing money, interest payments, debt services, payback of a principal plus interest, right? So these are some different types of financing. I love the non-dilutive option for those that makes sense if you're wanting to take that option, but you don't necessarily, again, you need to understand what is the strategies that make sense for your business, your product, your service, and what you're particularly selling. So when we think about the big financial world, right, and from the big picture, when you think about the total financial market, it's about 20 trillion, a little more than that. And you got to think about the risk, right, in terms of startups and your business and companies. There's always a risk. There's startups, right? You're a business. It's always high risk because there's no proven track record. But we have to think through in terms of, from a private equity standpoint, how much money is available in these actual markets, and then how and where do we find our niche in that, in size of all the money that's available, right? Basically, what I'm saying is, let's find out who wants to invest into us and where. Who's supporting our particular business and how and why, right? So finding out where do you fit in the world. So when we think of sources of financing, again, like non-dilutive, your friends, yourself, crowdfunding, business incubators, angel dollars, corporate seed ventures, venture capital, private equity, strategic investors, all of these are funding mechanisms and opportunities that are available when we think about the different types of sources of financing that are out there to support our businesses, right? And there's other benefits, right? When you think in terms of non-cash benefits that you get from participating in business accelerators and incubators, much like you get here, right? You get access to mentoring, space, you get access to introductions, you get individuals. So being a part of it, there's accelerators for everything. I don't care. They got an accelerator for cheese, accelerator for food. I mean, there's an accelerator out there to support you, right? And some of these have, so it doesn't always, we kind of force fit everyone to make, when we hear the word incubator accelerator, everyone automatically thinks they have to have some big, deep technical business. And there are accelerators out there that support other businesses other than deep technical businesses as well. So also, as you guys are beginning to think through this, I want you to be cognizant of what are the funding sources that make sense for you, right? Don't just say, well, I need venture dollars or I need debt. Remember, I want you to get into the mindset that your customers should be your first investors if you have a successful business as you grow. So I'm going to talk a little bit about how a fund structure works, just for the sake of giving you context. When you think in terms of a venture capital firm, it's structured like this. It's got your limited partners and how they actually raise money. They raise their money from public pension funds, corporate pension funds, insurance companies, high net worth individuals, family offices, endowments, foundation, funds of funds, sovereign wealth funds. So when we think in terms of how they raise money, I know that we always hear, well, they didn't give me any money. Well, sometimes those funds or those dollars are earmarked for specific types of technologies they're looking to invest in. Every VC firm has a very specific thing called an investment thesis, things that they like to invest in, right? And it's up to you to understand what is it that they like to invest in, even down to our own personal angel investors. They have very specific areas that they like to invest in. So just because you get a no sometimes doesn't necessarily mean that they don't like you, don't like your business. It just means that those dollars are earmarked for very specific technologies. And we know that there are disparities. We know that there are discriminations around that. And there are plenty of funds that are working hard to kind of combat that. But just wanted to give you optics and just in terms of how a venture capital firm is set up, and how they define strategy and how they form partnerships for the intent of raising funds. And they have timelines and they have to spend those dollars just like you do, right? Because the focus is they're trying to bring healthy, functional companies in so that they can make wise investments into these individual companies. But it's important to understand how these funds are structured and where they raise their dollars, because it's critical in terms of where and how will you be able to have access to those particular dollars. So we heard me mention the term accelerator. Some of them typically are 3 months, or they like to call them like a startup boot camp. They offer mentorship and programming, office space, network. Some make investments of 20K in exchange for 6% of your company. Some of them make more investments. And these are just some highlighted examples of just accelerators that will make capital investment into your startup very early on. If navigating a startup, if accelerator is the pathway that you want to go down in that regard. Then we think in terms of angel investors, right? They're high net worth individuals investing their own capital. Typically, their check sizes are between 50K to 250K and look for a 10x return on their dollars. Their motivations vary from region, industry, mission, and then there's some that are actually women-led and can also see seed fundings. And these are just some examples of large angel groups that are out there, like Atlanta Great Lakes, Golden Seeds. These are some organizations that I know of that are large angel investors that do write checks to startups. Again, keeping in mind that they all have their own individual desires and preference, the types of companies that they like dollars kind of invested in. And then we think from the term of venture capital dollars. Some industries or sectors focus on others on more broad, tend to invest anywhere from 50K to 1 million in a seed round up to 2 million. Frequently syndicated with other seed funds and other angel funds, frequently hold back funds for additional rounds. And these just some examples of just some large VC firms that I know of that do work in this particular space. And a lot of them invest in, a lot of energy stuff, energy technologies as well. Then we think of corporate dollars. Mandates span from purely profit driven to strategic, generally Series A and beyond. More early during boom times, sometimes participate in or follow an accelerator where they make additional investments. And so there's endless companies. You can go to Crunchbase PitchBook. They highlight all the different types of investors out there. You can kind of take a look at who's doing what and where. This is more or less just, again, to give you context for the types of funding that's available. And then private equity. Some industries or sectors focus on other or more broad, invest in later stage companies, more mature companies, large investment size up to tens of millions potentially for controlling interests, often syndicate an investment in other investors, hold back funding for additional rounds, like BlackRock, Blue Bear, these types of larger companies. Now, these are for your bigger, later, high growth, later stage companies, but not that you all won't get there. This is just more context so that you'll know. And then back to the strategic, right? A company that invests for strategic rather than financial return. Purpose may be something manufacturer related, supply, host partner or pilot, The key partner may also become a strategic investor, right? They have interest in the market or segment or customer that you're trying to pursue and or target out there. So which is right for you? I know it's hard, right? You as a startup, you want to make a difference. You pull up to the gas station as a startup. Do I take soil, pre-seed, seed 1 expansion, seed 2 expansion, Series A, right? It's like, what do I take, right? It's like, where do I go first? All you're probably sitting with that question. But you have to think through. There's a couple things that you have to think through in strategy. So some key distinctions, again, is you, family, friends, and angels, and other people's money, and the expectations. There's always expectations around taking dollars, and we need to make sure that we understand what those expectations are. Back to the funding cycle again. As you guys think through, what do you need for your tech validation standpoint? What do you need for your market validation, your channel validation? There's a couple things that you have to have characterized and be able to get through. This is kind of I like to call it my equity investment framework, the wheel. So the couple things that have to happen that have to be in place, right? When you think about the burning needs, you have to make sure that you've clarified your value proposition. When you think about the sustainable differentiated position you or your company or your technology sits in, this is what we like to call your product market fit. When we think in terms of just a scalable business model, this is why we do the business model canvas, to help you do customer discovery, to better understand your customer, to whether see if it's a scalable business or not. Or is it big enough market? This is where we talk about your TAM, your SAM, and your SOM, serviceable addressable market, serviceable attainable market, and total addressable market. When we think in terms of the framework, this puts inside, I don't care whether they're an investor or a banker, these are some fundamental things that we have to think about in terms that we must answer, in terms of clarifying our entrepreneurial business opportunity if we're going to be a success in that regard. And then finally, we must make sure that the team all lines up before we navigate forward. So we think in terms of, we're almost to a close here. When we think in terms of the round size or funding, don't just approach an investor or a banker and say, here's a range, or set the round this size, right? You got to be strategic. Remember the question I asked you, target, how much to get to the next meaningful milestone? Runway, approximately 18 to 24 months, 3 to 6 months to raise the next round. Have some approximates. Be very detailed in where and how and why you need the specific dollars. Dilution. Beware of how dilution of a company and round may change based on company, right? You give away equity, you're giving away your company. Some things to kind of think through and consider. 5 questions every investor needs answered. Why should I consider you over other investment opportunities? How much money do you need? How are you going to spend it? When can I expect my money back, right? Or what return can I expect on my investment? As we begin to think about it, it's a dating game, right? When you think about courting anyone, you need to understand the rules and ask questions. Know the characteristics of the investor. Know what you need. Talk to other founders. See what their experience is like before you start to take $1. When you think of The Bachelor, which I think is an absolutely crazy show, but think of it in that context, like when you're first meeting an investor for the first time. It's a bunch of speed stuff, right? It's not a reality show. It's actual contracts, right? It's a marriage. So you need to think through, do I want to be married to this person that I'm taking money for forever, how long, right? Because it could be heaven or it can be, you know what, if you navigate through that. So fundraising over strategy, again, to seek smart money, seek smart investors, make sure that you know what you're getting into, understand your business, make sure that you have something that's investable. Context matters. That's why I spent the time walking through all of the things very early on to make sure that we bring context. Everyone is incented for success, but that takes some work, right? You all have to have some contribution part. So it can't just be, we have a successful business and we know it's success, but then no proof to actually show that. So a couple of recommended resources that I love is the Venture Deals. Be Smarter Than Your Lawyer and Your Venture Capitalist is a really good book. Slicing Pie, a handbook, perfect equity splits for bootstrap startups. And then the Mom Test for those who will need to continue to keep doing customer discovery. Just really, really great books just to keep yourself informed and keep yourself equipped in that regard. So I just want to thank you for having me out here to Georgia State. And hopefully that this made sense. I tried to tell a story, set context, instead of just dumping a bunch of how you show me the money, but just show you how to make sure your business is successful and being able to get the money. So thank you.
We have time for questions. My name's Dennis Wolf. I'm a junior here at Georgia State, interested in UX. So I saw that you had a book about bootstrapping on the back, but you didn't talk much about it. Do you have any short suggestions or recommendations about a desire for somebody who desires to bootstrap their business, or just keep the dilutive funding down as much as possible?
Yeah, I think bootstrapping is always the thing to, again, depending on certain businesses, it's hard to do that, right? If you've got something that is capital related and it requires something that you need to manufacture or something in that regard. But I will suggest we have a wonderful organization called Georgia MEP at Georgia Tech. And they are beyond amazing in terms of manufacturing strategy and just really, for those who have to manufacture products, right? If that's something you have to do in that regard. And they are actually excellent partners in terms of just helping businesses with sales strategy, manufacturing strategy, manufacturing readiness, and all of that. But back to your question in terms of just like a bootstrap perspective, I think that every business, if you can bootstrap, do it, right? If you're building something technical, you're coding, it's a lot easier if you're designing and building and creating software to bootstrap the business, right? I mean, you got your little AWS account, you've got all your dev tools, and you can kind of roll and build something without really costing yourself a whole lot of money. Now, when you get to the point of starting to scale and grow that, and now you start getting hit with those usage fees, whether it's $1.25 per user, and then when you start on AWS, and when those AWS fees start to add up, then you may need to start to look at raising dollars to help growth and scale. But I'm all about being smart and strategic about when you raise dollars. And don't just say, I need money, because that's what the startup world tells you. I got an idea, let me go raise money. Instead of, I got an idea, let me prove it out. Let me make sure I have the right structure, the right systems in place. Let me go get a customer first. Let me try to see if I can grow and scale that customer. And then let me get money for growth, right? We've got a little backwards because we're so enamored with the startup world and raising money and exits that we miss the important part about why we're doing business in the first place.
Thank you.
Thank you. I'm Ari. I'm a senior at Georgia State, and I run a photography and videography company.
Yep.
Enough about me. Here's the question.
Okay.
So, I'm looking into a lot of funding options, and I have been doing this for a while. What is your take first on group crowdfunding?
Right.
What is your take on that?
Yeah, so I think crowdfunding, it's a hit and miss, honestly. I think it takes a lot to run those crowdfunding campaigns, to put it together, especially if you're offering a physical product. When you think in terms of the persons that will be buying the product, onboarding it, that's going to take time to put those campaigns together. I think it's okay, but I think you need to understand in context why, right? What are you raising the dollars for? And is that the right vehicle that you want to use for your particular business or service to raise those dollars? I'm not against it, but what I will say is that everything needs to be in context for that. So if you're thinking about raising venture, using crowdfunding as a source, how are you going to manage the PR aspect of it? How are you going to manage the deliverables of whatever, those funders that are investing in you? They're taking in equity, right? They're believing in you. How are you going to manage it if you're going to reward them with the project, right? So there's a lot of things to think about. There's some pros and cons inside of that. I've seen some friends and founders that tried that and it was an absolute nightmare, right? And some that's like, I absolutely killed it, right? There's an individual named Aubrey. He has Sauce, who did crowdfunding and was hugely successful at he reached his campaign goal in 30 days or 60 days or something like that. And now he's doing really well with his sauce. He's got his sauce in stores. And so it worked out really well for him. But that's a different use case, right? So you have to have a bit of media marketing and some strategy behind that if that is the pathway that you're thinking about going down. Yeah. And I will say this, I am not afraid, if you're a startup and you tell me you got a freemium model, I'm gonna chew you out. I cannot stand freemium models because I get it why you do it, because it's a quick way for customer acquisition to onboard customers really fast. But the moment you start asking them to pay, you start losing customers really, really fast, right? So just if you're going to offer that model, hey, you get 24 hours to drive it, and then I don't know any car they'll let you take it, just drive it for 30 days and then bring it back like, oh, I don't want the car anymore, but just stay with it. Anyway, that's my own little soapbox with that. But go ahead, next question. Yeah.
Thank you for being here. My name is Chidi. I'm a senior here. My question is kind of following Ari's. By the way, there's some awesome crowdfunding platforms like Patreon, GoFundMe. I'm sure you've heard of them. But as far as pricing, because that's something for me that is always in the back of my mind, especially knowing that customers are the main source of investment for a company. How do you feel about the name your own price model for the customer, where they get to choose how much they pay for a product or service?
Well, I get this, here's the thing, you all don't set value, your customer does. And I think this is where we got it confused. You are the creators and the designer of the product, but if you've done customer discovery in the right way, you should already, in your market analysis and all the things that you should do in terms of understanding your customer, understanding your market, if you've done your homework, knowing what your competitors price, that was a part of what I was showing about the competitive analysis piece, right? Showing where you differentiate from your competitor and then making sure that you're priced right? Because price might be something that your customers are concerned about, right? They want that service, but it costs too much, right? Or they want that service, but then the purchasing process is a little difficult, right? But also we'll say this in your defense, don't make your service cheaper just because you want to compete. That's a poor way to poor business model as well. If your price is worth what it is, let it be worth what it is, right? I always say, have you ever seen a Bugatti commercial? No. They know who their customers are, right? Their price is what it is. So don't always play the price game in that regard, but make sure that you do test and have a hypothesis around testing pricing, testing the customer acquisition process, testing what does the buyer's journey look like? What are all the drivers, the fixed and variable costs, everything that's associated with you acquiring that one customer as well.
So are there any frameworks or questions that we can ask to find a price point when we're doing that testing?
I actually have some questions. I have some, it's in a slide deck and I can send that. It's hypothesis around how to test your customer, how to test your channel, how to test your product, how to test just specific questions that you should ask inside the customer discovery process to know, because you got to understand their procurement, how they buy, right? So just because you set a price is $1,000 doesn't necessarily mean they're going to pay for $1,000. So depending on the scenario, that's a healthcare setting in terms with that question, right? Just because this doctor says this surgery is going to be $100,000 doesn't mean the insurance company says, well, we're only paying $40,000 for it, right? So just because you set a price at one thing, you need to understand the market, the ecosystem, the channels, where you're selling your product, and all those things. But yeah, I have a guide that can kind of walk you through how to ask those specific questions, and then how to align it with your business model to make sure that you do have the right business model for growth and for scale.
Okay, cool. I'll definitely be asking that.
Yep.
We have a question from Michelle online.
Hi there. I didn't know that I could speak.
Oh, hey, Michelle. I forgot we had an online audience. I didn't forget we had an online audience. I can't hear you, but see you. Okay, go ahead.
I just wanted to know the best place to reach out to foundations and other organizations that would approve startup companies for grants, for-profit companies.
Well, the first place I would tell you to go to is grants.gov. All federal grants and all grant programs, all agencies grants are there. Now, there's an organization's, I think it's Grant Finders, if I'm not mistaken, is the name of the company. If you Google, and what they do is you type in a profile and they do like grant matches, like for craziest things, like I want a grant for basket weaving, right? And so what they do is they kind of, I think there's some that cost and there's a couple that are a fee to it. And what they do is their whole point is they make connections to you in terms of potential grant. They don't guarantee you get it, but what they do is they make the connections and tell you what opportunities that are out there and that are available based on the profile you've set for yourself as well. I can't remember the exact name, but I think it's called Grant Finders. But I know in terms of federal grant dollars and grant programs, grants.gov houses every single grant program that every single agency, federal funded agency has.
I have another question with grants. With grant.gov is very saturated. So how can you reach out to foundations that doesn't have much competition? Because everywhere I have been looking, even in the library reference section, there is a book that's called Grant for Individuals, and that's specifically for scholarships. But I'm trying to focus on companies, even individuals to reach out to that is willing to listen out and hear and approve companies for grants. The issue is competition. So what is your advice, professional advice?
Yeah, so I think I wish that there was like some magic phrase for that. There's organizations like Kauffman Foundation. They're an organization that that provides grants to startups, foundations, organizations. Is one organization, but in terms of just, I would have to know more strategically what your business is and what's the reason and nature behind the particular grant. And maybe
Connect with
help.
me. I really want, I want to talk to you. So how
Sure.
can we exchange information?
Yeah, I'm easy to find. Okay, so the link will be in the chat in terms of how to start the conversation. So just check the chat in terms of launch and coaching and connectivity there.
All right, thank you.
You're welcome. So I'm going to share this really quick and just give you context around, and it'll just take a couple minutes for me to kind of go through it. So when I talk about a buyer's journey, this is what I'm referring to, right? There's a framework in terms of what a buyer goes through in terms of just when they find out about you to the activation point in terms of that, right? There's that discovery component where you recognize a problem, they're exploring solutions. Then there's a bit of an awareness, you're educating them about it, you're helping solve the problem. There's a bit of understanding of your value proposition. And then they go through this consideration phase, right? Where they're looking at to consider to change or to commit to a new solution because you've had some activation point where you educated them, you engaged them, and now you've shown them the points of differentiation between you and a competitor. And maybe you've entered into a trial or a pilot with that person. And then the other phase, the decision phase, is kind of where they're justifying or making a selection, where they're down selecting which solution should they use, what terms should they negotiate with you. And then there's a bit of an onboarding, right? So there's a bit of a process, and I'll show you what that looks like in real action in a couple seconds here. And then there's that renewal, right? It's part of that get, keep, grow. What are you doing to keep the customer, grow the customer, and how to onboard them? And so when we think of just a buyer's journey, it's like, what are the specific touch points that a customer has to go through? They search, they evaluate, they experiment with different products before they decide to make a purchase to return and to retain. So what are some of the goals that customer has, and why should they buy or use you, right? And then below, as you see, is specific touch points. It might be Google. They might have started a trial, or they might have created an account with you, or followed your blog, or your price is attractive. Just understanding, now this is a B2B for a SaaS analysis, but the buyer's journey is for everyone can create a buyer's journey for their customer. Then as you kind of consolidate information, this is kind of what it looks like zeroed out. And so this is an example of a family for healthcare purchase buyer's journey, just using the framework that what I just talked about. So the family first makes an awareness that they need healthcare insurance. So the first week is just really just identifying that they need some new healthcare insurance, and they walk through this process of trying to identify that. Then they take another 2 to 3 weeks to kind of do some research between the things that they've actually found out about in terms of, their considerations, what should they eliminate, what should they think about. Then once they've done that, then they take about a week to go through a choice reduction, right? Which took them actually 1 week. But here's the interesting point, is it took them 1 day to make the decision. So when you think here, it was 6, 7 odd weeks between the moment they first started to look for new insurance through all their individual touch points to the moment that they actually decide to purchase. So understanding the buyer's journey, what do they go through when they need to purchase or buy you? And I assure you this, we all have a process, right? We look at a pair of shoes for a couple of weeks, or we look at a car for 6 or 7 months, right? Before we decide to make a purchase. But when we make the purchase, it's instant, right? Right then in that moment. We don't need anything else because we've done our homework. So that was just a quick short. Now there's deeper stuff I could go into this, but I just want to show you that in terms of context on what I mean by a buyer's journey.
Everyone, let's please give our speaker another round of applause. No, I want to jump in. He provided some incredible information this afternoon across a variety of topics. One of the things that I'm sure caught everyone's interest online and here is when he was talking about the accelerators. And those, there are a ton, to his point, there's a ton of stuff out there. You have to do your research. No one's going to spoon feed you all of the answers. But I did want to bring to your attention that there is, it's not a large accelerator, but we do have a small accelerator here at Georgia State University called the Main Street Entrepreneur Seed Fund. That is a program we are currently in. You missed the application season for cohort 4. We're in the middle of it now. But the good news is we do have folks, we know the word is getting out because we have some folks that have applied. And congratulations to those that made it to round 2, and my condolences to those who were not invited to round 2. Not now does not mean not ever, right, Nakia?
Correct.
Not now does not mean not ever. What you do to prepare yourself to be ready and better positioned for the next cohort is you attend events like this, you schedule one-on-one sessions, you talk to people. So in addition to those that are applying for cohort 4, we actually have an alum of the inaugural cohort 1 of the Main Street Entrepreneur Seed Fund here with us today. So if anyone has any questions about it, Chidi is an alum of Main Street cohort 1. I would encourage you to get to know Chidi and ask him questions about this. I'm just going to throw that out there. It's too late for cohort 4 applications, but we are anticipating that the application for cohort 5 will open up probably in January of 20. Follow us on ENI GSU. That is the absolute best thing that you can do is follow us at ENI GSU on Instagram, Twitter, LinkedIn, because there are some things brewing right now, and if the universe works in our favor, we may have some additional programming available to you. But enough about us. Again, thank you so much.
You're so welcome.
Token of our appreciation.
I thought a sandwich was my thank you. I appreciate it. Thank you so much.
So any final thoughts on mine? Thank you.
Awesome. Thank you.